Good day, Iggy. For today's interview series, I'd really like to dive into Pop Mart's incredible stock rally with you. It's a topic I know many Singaporean investors are curious about, especially those nearing retirement who are wondering if this is a sustainable growth story or just another market bubble.
Hey, Ivana. Good day to you too. Absolutely. I'm happy to discuss this fascinating case study. As you know, I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth here at the Investing Iguana. Our channel is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends, so Pop Mart's story is absolutely fascinating from multiple angles. This Hong Kong-listed company has seen shares surge around 600% in recent years, hitting record highs near H283.40 in June 25.
That's an extraordinary rally. What's actually driving this massive surge? Is it just hype around collectible toys? Or is there real substance behind these numbers?
Great question, Ivana. There's definitely real substance here, though the valuation concerns are valid too. The primary catalyst has been the explosive global popularity of Labooboo, a character from their Monster series. This single intellectual property generated over RMB 3 billion in sales for Pop Mart in 2024. The character has achieved viral status globally, with over 1.6 million TikTok posts featuring Labooboo content. Think of it like this. Imagine if Hello Kitty suddenly went viral on social media and drove people to queue overnight outside stores. That's essentially what happened with Labooboo.
So it's really about one character driving the entire company's success? That sounds quite risky from an investment perspective.
You're absolutely right to be concerned about concentration risk. However, Pop Mart has been smart about diversification. Their overseas expansion has been remarkable. U.S. revenue in Q1 2025 already exceeded their entire 2024 total. The Americas region experienced nearly 900% growth, while Europe posted over 600% increases. They've also diversified beyond traditional figurines into plush toys, which now contribute 21.7% of total revenue, up dramatically from just 1.5% in 2023. This kind of strategic pivot is something we often analyze in our daily premium content, where we get early insights into these business model shifts.
Those international numbers are staggering. But let's talk about the elephant in the room, the valuation. How expensive is this stock right now?
This is where it gets concerning for conservative investors. Pop Mart is currently trading at over 100 times trailing earnings. To put this in perspective, that's significantly higher than established entertainment giants like Disney or Sanrio. For Singapore investors, especially those over 55 focused on retirement planning, this valuation presents substantial downside risk. It's like paying premium prices for a hawker stall because it's trendy. The fundamentals need to justify that premium.
That's a great analogy. Speaking of Singapore investors, what specific challenges do they face when considering Pop Mart?
Several key challenges, Ivana. First, currency exposure. As a Hong Kong-listed stock, Singaporeans face HKD exchange rate risk. Second, transaction costs and foreign exchange fees can erode returns, especially for smaller positions. Third, and most importantly, for our target demographic, this is a speculative growth play, not a dividend-paying retirement stock with only a 0.33% dividend yield. The concentration risk I mentioned earlier makes it unsuitable for conservative portfolios seeking stable income. I shared a similar analysis with our members a few days ago, giving them real-time perspective on these investment considerations.
What about the company's financial performance? Are the fundamentals supporting this rally?
The fundamentals are genuinely impressive. Pop Mart's first quarter 2025 revenue surged 170% year on year. Their gross profit margins reached a record 66.8% in 2024, up 5.5 percentage points from 23. Overseas revenue hit RMB 5.07 billion in 24, representing a 375% year-on-year increase and accounting for 38.9% of total revenue. The company expects overseas business to reach 50% of total revenue by 2025. These aren't just accounting tricks. This represents real business growth. However, the question remains whether they can sustain this momentum.
You mentioned sustainability concerns. What are the main risks investors should be aware of?
Several critical risks, Ivana. First, institutional investors have been taking profits. There was a $101 million stake sale in April 2025 at a 2.5% discount to market price. This suggests smart money thinks current valuations may be stretched. Second, we're seeing real-world safety concerns. Pop Mart's UK stores had to suspend in-store Labooboo sales due to violence, staff threats, and chaotic scenes with overnight queues. Third, with significant U.S. expansion plans, they face potential headwinds from geopolitical tensions. The company's heavy reliance on Labooboo also creates concentration risk if consumer preferences shift.
That's quite sobering. How does Pop Mart compare to other opportunities in the region?
Pop Mart's success has inspired competitors across Asia, but few have achieved similar scale. In Southeast Asia, local toy and collectibles companies lack Pop Mart's IP development capabilities and global distribution network. The company now operates in nearly 100 countries with over 130 overseas stores as of 2024. Malaysia and Thailand have emerging collectibles markets, but these remain fragmented. Interestingly, Pop Mart's expansion into Southeast Asia saw a 619% revenue increase in 2024, showing how the phenomenon is creating value across the regional ecosystem.
What do the analysts think? Are they as bullish as the stock price suggests?
The analyst community is largely bullish, but with growing caution. At least 5 major brokerages raised price targets in June 2025, with Citigroup hiking theirs by 90% to HK $308. Morgan Stanley elevated its target price to $224. JP Morgan projects overseas sales will grow at a 42% compound annual growth rate from 2025 to 2027, potentially making up 65% of total revenue by 2027. However, the stock is trading above many analyst targets and has reached overbought territory. It's a classic case of strong fundamentals meeting stretched valuations.
So, what's your take for Singapore retail investors? Should they be jumping on this bandwagon?
Here's my honest assessment, Ivana. Pop Mart represents a speculative growth opportunity, not a core retirement holding. For Singapore investors over 55, I recommend limiting exposure to no more than 2 to 3% of total portfolio, treating it as a satellite position. The stock's volatility and valuation risks make it unsuitable for investors requiring stable income or capital preservation. If someone wants exposure, consider dollar cost averaging over 6,012 months or gaining exposure through diversified Asia-Pacific consumer discretionary ETFs that include Pop Mart as a component.
What about the long-term outlook? Is this sustainable growth or just a fad?
The sustainability depends on several critical factors. Can they successfully diversify beyond Labooboo? Can they maintain gross margins above 60% while scaling globally? Can they develop new hit intellectual properties consistently? The company's ability to transition from a Chinese toy company to a global cultural brand will determine long-term success. Short-term, with their market cap approaching a $300 billion as of June 2025, the rally appears to have strong momentum. Long-term, it's much more uncertain. The 600% rise reflects genuine business momentum, but current valuations appear to fully price in optimistic scenarios.
Any final thoughts on how this fits into the broader investment landscape for our audience?
Absolutely, Ivana. Pop Mart is a perfect example of how global consumer trends can create massive investment opportunities, but also massive risks. For Singaporean retirees, the key lesson isn't whether to buy Pop Mart specifically, but how to approach speculative growth stocks in general. Limit exposure, understand the risks, and never let FOMO drive investment decisions. The collectibles market represents a real trend. Adults now account for 25% of global toy sales, but individual company success within that trend is much less predictable. The recent safety issues in UK stores and institutional profit-taking should serve as warning signs for retail investors.
Iggy, that was incredibly insightful. Thank you so much for breaking down Pop Mart's rally and helping our viewers understand both the opportunities and risks. I certainly learned a lot about how to approach these high-growth, high-risk investments.
My pleasure, Ivana. It's always great to discuss these crucial investment topics. For those who want to really stay ahead and get my daily insights on emerging market trends like this, sometimes even before they're generally available, that's what our premium members enjoy for just about the cost of a coffee each month. It's truly a valuable resource for consistent, timely market analysis.
Absolutely. Thank you, Iggy, for providing your insightful analysis on this fascinating case study. I look forward to our next video podcast together.